everyone, my name is Jala. I'm with LPT Realty.
And my name's Matt, and I'm with Blue Gray Mortgage.
And we're here to talk to you about first-time investors today. If you feel like you fit in this category, stay tuned because this video is for you.
We're going to start off talking about the biggest hurdle first-time investors see in today's market. So a lot of first-time investors might get discouraged because they maybe don't think they make enough money to, afford another property that they can rent out. So what's a way around this? You buy a new property, you are actually going to be able to use the rental or projected market rent from that property. What's going to happen is an appraiser is going to go out and he's going to determine what that market rent is. And you're actually going to be able to use 75% of that rental income to count towards the overall income you are going to be able to qualify with.
Can you use an FHA multiple times or is it just one time?
That's a great question. So you actually can use an FHA loan multiple times, and this is a strategy that people do all the time is they'll get an FHA loan on a primary residence. That way you get a lower down payment of 3.5% opposed to 20% that's required for an investment property. You're also going to get a lower rate. Now there's a big misconception that if you were to move out of your property after a year that you have an FHA loan on, that you're not going to be able to get another FHA loan. However, you can. After a year, you're able to do so. If you're gonna get another FHA loan, you can actually use the future rental income from your current primary to help offset the mortgage of that current primary so you can afford to buy this new home.
So basically, in other words, what he's trying to say is if you were looking to purchase another property and keep that current one, you can use an FHA to purchase your next property as well. As long as you've lived in that property for 1 year, you can purchase up to 4 units. That means a quadplex with an FHA. So besides an FHA loan, what else is there?
So there's actually some other options you're gonna have, and a very popular loan at this point is called a DSCR loan, Debt Service Coverage Ratio loan. So basically what's gonna happen with a DSCR loan is no income is needed. If you're gonna even put employment information on the application, we would delete it off. We don't need any income. So what's the catch with this? So when the appraiser goes out and values the property, he's also gonna complete a market rent analysis, which is gonna determine the market rent for the area. As long as this market rent is higher than your mortgage payment, you're good to go and you qualify. So the best rates with this product are gonna be 25% down, but you can qualify with 20% down. Another barrier to entry with this product is you have to own your own primary residence. You cannot be renting a home and get this product.
What if we don't have 20% down? What can we do? What are our options?
That's a good question. So you have a couple options here if you do not have the 20% down. One is going to be a HELOC. HELOC is a loan that is going to be based off of your primary residence. You're going to have a certain amount that you're going to take out. Usually you want to at least take out $50,000. Most lenders want to see that. And that new rate you're going to get is only going to apply for that $50,000 or what you're going to take out. You can use this money you take out as the down payment on your new property. And that way you can get that 20 to 25% equity you need. Another method you might employ is a cash out refinance. So a cash out refi is going to be best if you own the property free and clear, because at that point you're not going to have this low interest rate that you're trying to protect. So with the cash out refinance, it's kind of like the HELOC, except you're going to get one lump sum payment at the beginning. For the HELOC, you're only going to be paying a mortgage payment based off your draw amount. So if that's $50,000, $75,000, so be it. For the cash out refi, you're going to be paying interest on that entire lump sum over 30 years, 15 years, whatever you want to do.
And what's great about a HELOC is, and by the way, a HELOC stands for Home Equity Line of Credit. So what's great about a HELOC is it allows you to go up to 80% of your home value. So if you have completely paid off your home, you can get 80% of the purchase price that your home is worth. So if your home is worth $500,000, you can get about $400,000 of that pulled essentially, and you can go and purchase another property with that.
One more thing to touch on with these cash out refis is the product I was talking about before, the DSCR loan. You can actually do a cash out DSCR loan. So let's say you have a couple of investment properties that you either own free and clear or have a mortgage on. Like Jala said, you can take up to 80% out on this product as well with a cash out refi of the home's value. So they're going to do the same thing. They're going to look at the market rent, make sure that rent is higher than the mortgage payment. If you have a lease in place already, some lenders will actually let the lease supersede what's going to be on the market rent. So this is a very popular product investors are using to get money out to buy another property.
Here's just a few things that we have talked about today. Obviously, there's tons and tons of other sources out there and other types of loans out there that can get you started on first-time investing. Please contact us and find out more information if you're curious or you just want to know more. It's a call. We'll be happy to talk to you.
Take care.
Have a good one.